This is a trade recap for March 6th, Friday, 2026. Continuing on with one and done. This was number 26 of 30, so definitely coming into the end there. Kind of interesting morning in the session. Trying to think of how to phrase it. Again, kind of like very hesitant and picking a direction. But again, it's one of those things where exposure to new and different levels of volatility, market games, whatever is always a good thing. Because it just again experience is the big thing that we all need to be building up, and that's what really again will make or break you is just exposure to every kind of market and market condition. So the more you of that you get, the less that you will be again caught off guard with as you continue in this little journey and build yourself up to a professional level trader. But to do that, I would highly recommend finding someone that has kind of blazed that path already. So that would be a good mentor and coach. And if you've watched any of my videos before, you know who I'm going to recommend, and that is Pat Mitchell over at tricktrades.com. He has been in the markets for over a decade and he knows exactly what he's doing. So if you are looking for that high level coach and mentor, he is the one that you need to be learning from. He runs an education service called Trick Trades. Like I said before, you can find it at tricktrades.com. He's been in the markets for over a decade. He also has a YouTube channel. You can pop over there and see that he has a ton of videos, over 1,700 videos at this point, with all kinds of different knowledge and lessons that you can watch, pick through, and get a preview of the level of information he puts out. And that is just, again, tip of the iceberg because he, again, gives lessons every day on screen share. So it's one of those things where if you really want the full package, you do have to join. And the quality of the education you receive on the inside is, again, there's nothing like it out there. And with that being said, we can go ahead and get into the trading session. So pop that up here, pop that down. See here, find the live session here real quick. And bum bum. That should be good. Bring that in. Here is the recording of the live trading session from today. This is coming into the open. If you're new here, kind of lay the land. Daily charts here on the left, 1 minute intraday charts here in the middle. Then I keep my order execution here on the right. These blue levels that you see on the daily are the levels that Pat plots out the night before and then refines the morning of a trade session and builds the trade plan around that. And then that is what we trade. Only trade that. We don't do any other trades, and those levels do not move or get adjusted. And one exercise I like to do is again try to plot the levels before I look at or see Pat's, so I can see if my mind, my thought process is in alignment with his. It's a good little exercise. I throw my risk lines on there, risk levels, but that is a personal choice. You do not have. He doesn't do that, and other traders probably don't. But I like a visual marker on where my risk is, so it's easier to track. Again, personal preference, but go ahead and hit play on this. This is 10 seconds before the open. As you can see where we are, the channels in between Qs and SPY. So yeah, let's go ahead and get into it. As you can see, Qs is kind of coming up to test that level right before the open, while SPY has way more distance. So it's one of those things like you got to watch out for that. Another thing is with this gap down, that usually spikes the premium, the cost of the options contract. So it's one thing to also take into account. And we're going to do a little bit of that on Qs because Qs is kind of trigger probably first on that short level up there, but the cost of it, I mean, at that point in time, I was like probably looking at, when you account for risk, 4-ish dollars on the premium. So it's like one of those things where that's getting pretty expensive. So it's one of those things where you have to make the decision whether or not that it puts you outside of your risk tolerance. And if it does, then you don't take the trade. It's just that simple, which is what on Qs I said that that was too expensive to where what I would have to pay to enter and then potentially manage that trade. The risk exposure for me was just a little too high, especially considering the risk. What you'd be risking off of was up there. Again, it's about $1.50 ish or so. So, did it work ultimately? Yes. Would I have needed to add and manage? No. But again, it is what it is. So, as you can see, there's a little bit of divergence there as well on the two. So, SPY kind of came up, then starts coming down towards that lower level, while Q's is still kind of holding and pushing back into that shorting level. So, it's a little divergent. So, it's one thing. It's a good idea to kind of let that sort itself out. So as you can see, it actually took a little while for us to get into a position where I was comfortable executing with risk and the cost of the premium and having all that balanced out. So as you can see, I'll just jump forward. So again, was getting ready to take SPY there for a potential long, but ultimately did not come down into the level, which is where I needed it to enter. Qs is coming up to test its level once again. So it's, again, being cautious there just in case this thing wants to squeeze, because that first test has already happened and SPY is technically holding pre-market lows as support. So it looks like this thing wants to go higher. So just being patient and seeing that now SPY is getting down. Qs, again, is kind of that reverse situation now. Qs has some significant distance down to its lower level, but did have pre-market lows to use as support. So as SPY is coming down into its level, going to enter into the trade there and then just watch and wait. Probably going to keep my size relatively restricted just because of the speed in which, again, Qs could potentially drag SPY lower. So it's just one of those things you got to watch out for that. And again, the risk on SPY is also a little bit wider than typically would like it. But again, these are all factors you need to take into account before pulling that trigger. If you're not recognizing them, then maybe that says it's like, okay, pump the brakes and reevaluate or reassess that trade. Like, why aren't you recognizing those factors, those kind of inputs you need to really take into account? As we see, coming down on Qs to test pre-market lows. So right now it's looking like, okay, this is potentially going to go lower. Do see some buying there. So it's one of those things where it's like, okay, looks like there's some buying interest, but now it's below that level. So is it just going to come on and bump it and then fail? Like, that's the thing. It's like, you just got to let this play out. Can't be getting scared and jumping out of trade, in and out of trades off for little movements. It's like, enter where you're supposed to enter, stop out where you're supposed to stop out. What it does between those two levels, like, who cares? And that's something that Pat really, really impresses on. He doesn't care whether it does barrel rolls and backflips between the entry level and, again, where you would stop out. Who cares? Just let it do its thing and sort itself out. It's either going to do one of two things. It's either going to work out or stop you out. And that's it. It's just that simple. And then as we were kind of just putzing along here, starting to move up. So that's one was saying, boom, decided to take it off right into there as that reacted. Real basic trade. Real, again, that first reaction off of that level. And yeah, that was that. So then one of those things where just kind of run through it. And as you can see, it kind of just pisses around there at that level because it was trying to figure out what exactly it wanted to do. And then ultimately just kind of works there, comes down lower, comes basically down into the risk level before ultimately kind of pushing back up. And then it's like, okay, like, what are we really going to do? That's the thing. So it's interesting in that. That was just really just managed the level and did not necessarily know what it wanted to do. But ultimately, it's one of those things. While it did come down and ultimately get real close to that risk level, it did not technically stop out. So even if you hadn't paid yourself on these, like you still hadn't gotten stopped out, you would have gotten melted a little bit on the position where like adding into here would have been wise. But then again, with the elevated premium cost, are you again flirting with danger? It's like for small account builders, yeah, probably. I know I would be. I would not want to like I'd be real hesitant to add, especially if I added there. It's like, but I also know to pay on. I'm disciplined enough to pay on first reactions. So like on this one when it popped up, pay on that one. And for some reason I didn't, and or I was working to position because I'm a little bit further along and where I wanted to be. Again, would have added, had one there, entered there, getting paid on this reaction. Same down here, it comes down. It's like this one probably wouldn't have again messed around with this one all that much, simply because this is not looking too good. Even though Q's is kind of holding up, not entirely sure what's going to happen, but could have potentially again came right down into it, entered there, and again if it truly broke it, then it's like okay, just take it off. So again, having a larger account where you can take more size and being able to kind of build up a some padding in terms of profit to potentially take something like this because yeah, sometimes you get this nice follow through which really pays. So yeah, and again, as you can see on Q's as it came in this level, came up, rejected, came up, rejected, came up, rejected, came up, just broke above. It didn't really break above. It pierced the risk level, but didn't confirm above it. So that's not enough to really stop out. And then again, came down. So if you manage things correctly, it's like all of these were multiple opportunities to be green on these trades. So it shows that the market gives opportunities every single day. And that is something Pat teaches us that there will always be an opportunity long and short every single day in the markets. And you just have to do your job. And that's how you should be treating this a job. You punch in, do your job, and you punch out. Keep your emotions under control, keep discipline, stick to the trade plan, follow the strategy, all of these things, because again, that's how you get in and out of the markets and then move on with the rest of your day. So if you're interested in learning how to do this and how to do it to a professional level, come see Pat Mitchell over at tricktrades.com. If you're interested more in what he offers, check out his YouTube channel. You can also check out the SizeUp webinar, which is linked down below, along with a couple links to the memberships over at Trick Trades, which will get you a discount on your first month there. Hope to see some of you over there in the service. But if it's one of those things where if you're just looking at this as a hobby or you're not really sure, you might want to figure that part out first because you need to be seriously committed to really put the time and effort into doing this right. But with that being said, good day. Another green trade so far. So out of the series, with this being number 26, only that one red trade so far. And we'll finish this up next week. Other than that, I hope everyone has a great day and enjoys the weekend. And we'll catch everyone on Monday. And we will see you then. Peace.